Hello, it's Larry Gaines from Options on the Open. I wanted to revisit the Golden Cross. As you remember from my last blog video on Jan 25th, I pointed out that there was a Golden Cross getting ready to take place, and I went into an in-depth discussion in detail on what the Golden Cross is, and I gave you a video of that. But I just wanted to show you that it's finally happened, and it did take place, like I mentioned on January 25th, and now they're all talking about it on CNBC and Kramer and everybody else. But here you go. Here's the 50-day moving average, this line in yellow. Here's the S&P 500, which is the index basically that has the best broad history and the most actively traded stocks. And here's the 50-day moving average. Here's the 200-day moving average. As you can see, the 200-day is flat to sloping lower. So this is it historically has been a better setup for projecting trajectory of the market in the future if the 200-day moving average trajectory is showing a slope downwards. So you can see the 50-day has been just moving up, and then it crossed basically yesterday, February or January 31st, and today February 1st, so it's crossing over the 200-day. These are simple moving averages. So just to review some of the statistical history behind it, since 1942, buying after the cross and selling when the 50-day slipped back under the 200-day moving average netted 11 winners out of 14 signals, averaging 21.6% between the buy and the sell signal. The drawdowns were on average only 2.3%, while the maximum gain averaged 34%, and it took an average of around 359 days for the buy signal to be reversed, with the shortest being 81 days, or nearly 4 months. So the last time we had this particular signal was actually in 2009, and let me show you that. Now this is the moving average of the 200. You can see it's sloping down. It's even a sharper slope than we're currently having, and the market's coming from back in 2009 came from a lot lower point, but you can see that the 50-day crossed there, and you had this huge move to the upside. Here's another angle, but here's still the cross from June 2009, but you can see how the market was really coming from a severe sell-off. So we shall see how this trajectory extends, and let me just bring it back to the current chart. So we'll see how this trajectory extends, if there's some additional movement up, but past history shows that there has been some very positive signals to substantiate this Golden Cross, and currently you can see the market has been holding this 1300 on the S&P, consolidating. It's been very overbought, but it's consolidating, and that will work off part of this overbought condition. Now the market could still correct back. You've got this trend line here, and then make another move higher. So it doesn't necessarily say that this thing's going to take off and roar right from here, but the probability of it being up in the future is a lot higher based on this pattern. Next resistance will be here at 1340. You've got this descending trend line coming in from back. Let me show you back here in April of 2011, and then the highs there in June, July of 2011. So you've got this descending trend line that's been broken right now. That came in today. It was breaking around 1320. So you have some potential up here to 1340, and then the highs back last year 1370. So keep an eye on the markets based on this. Now one thing that could shift the market momentum and either take it to break to the upside, this 1340, or perhaps cause the market to pull back and correct, is going to be this employment number coming out Friday. So I think that'll be the next catalyst for the market, either up or down. Come join us at Options on the Open and learn how we trade options and trade weekly options. We're very, very successful with great returns on that. So look forward to seeing you at optionsontheopen.com. That's optionsontheopen.com, and thank you for your time.